Hi, I'm John Smith.
Hi, and I'm Elliot Foster.
Welcome to the 25th Annual Emerald Groundhog Day Investment Forum.
Since the election, we've seen a lot of change in the regulatory environment. All of it's been positive, and we think that in 2018 we'll see a lot of that actually play out in the market and add to earnings power for the banks. Big changes as far as the Fed board and the governors. There'll be a change in Fed governors from six of the 7 Fed governors will come in will be new. We've seen the CFPB actually become a little more friendly to the banks and less of a burden for the banks. So yes, definitely, and we think that continues to play out in 2018. The lower corporate tax rate for banks, it's almost like Christmas all over again. In that, they add about 20% earnings power. So, most of our banks have been taxed at about 40% or so. That'll come down to that 21%, in some cases even lower. I have one bank, their effective tax rate this year will actually be 8%. So that's going to add about 20% earnings powers to the banks within our portfolio. So we're super happy about that. Loan growth has slowed a little bit. 2016 was a tremendous year for loan growth. 2017, we saw a little slowing in growth, but we still think we'll be able to do about 9–10% or so loan growth overall for small community banks. But as you know, the banks that we invest in tend to be a little more growth oriented, so we still think we'll see high teens average growth rate for the portfolio. So we've been a little surprised. We were expecting deposit pricing to be a little higher with higher rates. But for the most part, the banks have been pretty disciplined. So typically, when the Fed when the Fed starts to tighten, we see deposit betas of about 40%. Deposit betas have only been about 25%, which is actually pretty good for the bank. So we'll continue to see net interest margin increase in this environment.
Great. Thanks for your time, Steve.
Thank you.